An option is a contract that allows you to buy or sell an underlying asset at an agreed price and time. Underlying asset means equities, bonds, commodities, and so on. It is divided into two types, call and put. And each option has two parties involved in it, buyer and the seller. The buyer of the options have rights to buy or sell an underlying assets, whereas sellers have obligations, or we can say compulsion to buy or sell. Option buyers enter into a contract by paying some price which is received by the option sellers. This price paid is known as the option premium. So how is option premium fixed? Well, it's not fixed by anybody. Instead, they are influenced by the financial and non-financial factors. So in this video, we will see 6 major factors influencing option premiums, starting first with the stock price. In the case of the call option, the option buyer makes money when the strike price of the underlying is less than the spot price. The reason is the option buyer buys the underlying at a lesser price compared to the market price. Now the question is, how does the spot price affect the option premium? Suppose the strike price is 900. If the spot price increases to 950, there is a higher chance of the option buyer making a profit because the strike price is less than the spot price. Instead of increasing, if it decreases to 850, the chances of not making money are higher because the strike is now greater than the spot. So naturally, investors will pay more premium when the spot is at 950 due to greater profits and demand. On the other hand, the premium at 850 would be less. For the put option, option buyer sells the underlying when the strike price is greater than the spot price, because this way he is able to sell the underlying at a higher price. This means the option gets exercised when the spot is at 850, and due to the increase in demand, the premium will be higher as well. So this is how a change in the spot price influences option premium. Second factor is strike price. So lower the strike price of the call option, the higher will be the call option's premium. For example, the spot is at 950 and we have two strike prices given, 900 and 1000. If we choose the strike price of 900, chances of the call option buyer making money is higher than if we choose the strike price of 1000. Therefore, the premium at 900, which is a lower strike price, is more than at 1000. For put option, an increase in the strike price will increase the put option's premium. Of course, when the strike is at 1000 and the spot price is 950, then the investor is having the option to sell the stock at a higher than market price. But if the strike price chosen is 900, which is lesser than the spot price, demand for a 900 strike will be comparatively less, and so will be the premium. Third one is volatility. Volatility means the variation between day-to-day prices. Option prices and volatility both are directly proportional to each other. So when there is a high volatility, both up and down risk increases. When the upside potential is higher, the buyer of the call option may make money, and when the downside potential is higher, the buyer of the put option may be benefited. Therefore, when there is a high volatility, option prices tend to increase irrespective of the call or put options. Next one is time to expiration. It has an impact on both call and put options. So greater the time for options to mature, the higher will be the probability of options moving in the favor of buyers. Therefore, longer the time to expiration, higher will be the option premiums. Similarly, the lower the time to expiration, the lesser will be the premium. Reason is, as the expiration date approaches, the chances of the options gaining in value are less because underlying security has less time now for making a major up or down move. Fifth factor is interest rates. So when interest rates rise, the cost of borrowing money to buy shares on margin increases. For example, if you want to buy 20,000 worth of stock on margin, the cost to use margin is higher when the rate is 6% versus 4%. Therefore, when the interest rates are high, it's cheaper to buy a call option than to purchase shares because purchasing call option only requires a premium amount. So we can see when the interest rates increases, demand for the call option increases, and eventually call option premium also increases. Moving on to the put option. So buying a put option means right to sell, but the sale takes place in the future. Now, because they don't receive any cash today, they lose out on the interest amount when the interest rates are high, which means during the rising interest rate environment, put options are less attractive. and therefore their premium amount is less. Last and sixth factor is dividend. This factor is only applicable to dividend paying stock options. Now, how exactly does dividend affect the option prices? Suppose a company is expected to give dividends during the period of the option contract. Once the dividends are distributed, the share price typically drops. Given that the spot price decreases instead of increasing, the value of the call option decreases, due to which the call option premium also decreases. On the contrary, because the spot price is decreasing, the value of the put option increases and so will the price. So to sum it up, the higher the dividend, the lower would be the price of the call option and higher would be the price of the put option. So that's about it. Hope all the six factors are clear. See you with another topic. Thank you.